So with stock market investing, one of the most common questions that I see many people wonder, including myself, is how do these top investors like Warren Buffett, Goldman Sachs, all these top names, how do they know which stocks to pick and when to buy it? So I put together a strategy after doing a lot of research on what these types of investors do to put together a strong framework to help you guys understand how they analyze stocks and the strategy that I personally use. Of course, we've got different types of stocks: growth stocks, value stocks, dividend stocks, whatever it is. There's going to be certain things you're going to want to focus on more depending on which it is. However, this framework generally works for all types. So starting off with the simplest step, that's the most important part to begin with. You have to understand what the company is. How does this business make money? Who buys from them? How are they different than other similar companies? So a great example I'm going to use here is Apple. Obviously, most of us know what they do. They sell a lot of technology products. However, iPhones are probably the most popular. Everybody has a phone now. The need for it is not going away anytime soon. However, we have other competitors, Samsung, Google, and so on, all these other companies that are making phones. But what makes Apple stand out over these others? One thing that I think is very important and helpful to this industry is, let's say someone gets an iPhone as their first phone, most people are going to stick with the brand that they build trust with and enjoy. So whether it's Android or Apple, whatever people start to stick with and understand how to use, they're typically going to continue to buy over the years. For this specific case, obviously Apple is the biggest competitor. So just again, going back over what step one is, make sure you understand the business. For a Warren Buffett quote, if you can't explain it, don't buy it. Step two is going to be judging the business quality. We're going to look at things called moats, which are pretty much competitive advantages that these companies have over their competitors. Number one is going to be brand power. You could have two of the same products. Let's say it's an iPhone. If it has an Apple logo on it and it's made by Apple, people are most likely going to pay more for it rather than if you put some random unknown company name on it, even if it's the exact same product. Or in some cases, even a better product. Another great example I'd use is Nike. We could have the exact same shoe on a shoe shelf, one with a Nike logo, one without. Again, other than that, exact same shoe, and people will be willing to pay way more money for the one that just has the logo on it. That's a perfect example of brand power. The second mode we're going to talk about are switching costs, something that a company may start to use, such as Microsoft, Adobe, that they may build their whole business on, which would be very difficult for them to leave and expensive. Bringing Apple back into this as my great example, for someone who's been using iPhones, AirPods, all this stuff their entire life, suddenly switching to Android, an entirely different run technology, it may be very difficult, or at least very annoying. So the higher the switching cost, the more likely customers are to just stay with the company. Number three is going to be network effect, one of the strongest modes. A great example I'm going to use here is Visa. If more merchants are accepting it, more people are going to want to carry it. Another example, Uber. The more drivers, the more riders are going to be attracted. It's a loop. The more people that use it, the more people it's going to bring in. Fourth mode we're going to talk about is cost advantage. This means that the company can produce and operate at a cheaper price, but still sell at the same price. Walmart and Costco are great examples here. Their scale lets them buy in bulk so they can undercut smaller retailers, but the last one we're going to talk about are exclusive assets and rights. Pretty much means that the company has something that nobody else can legally copy. Whether it's patents, exclusive data, mining rights, government approval. Pfizer's drug patents are a great example. Other companies can't fully replicate these things legally. These companies can profit off these things specifically in peace without having to worry about having competitors. So just going over that again, 3 questions I'd ask when you're looking for these. What type of moat does a company have? How strong is it? And how long can it realistically last? These things pretty much separate temporary profits from durable wealth over a long period of time. As Warren Buffett's famous quote goes, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Next, we're going to dive into the financial health of the business. So I'm going to put a chart up here that I typically follow. You can take notes on or take a screenshot so you can save for later. Just to go over some of the basics, for revenue growth, at least 8 to 15% shows some strong demand. Profit margins over 10% is ideal, over 20% is amazing. Return on equity being 15% or higher typically shows that management is using money wisely. For debt to equity, under 1 is ideal. Too much debt in even a really solid company could really hurt it or kill it. For free cash flow, of course, we want it positive and growing. It shows that we're getting real profit even after everything's paid. Now, moving on to step 4, valuation. How do we know if the stock's cheap or expensive? So of course, I'm going to want to be very specific here. Depending on the type of stock, a turnaround stock versus a growth stock, of course, we're going to expect a different PE ratio. But in general, for stocks overall, 15 to 25 is a good range to be in. Anything over 40 is generally a bit too high unless the company's growth backs it up. Nvidia is a great example. It has a bit higher PE ratio, but its growth definitely backs it up. PEG ratio under 1 typically shows that you're getting good growth at a good price. For price to sales, under 2 is cheap, under 6 is fair for tech stocks and things like that. For price to books, under 3 for steady industries is what I typically look for. However, it's fine if it's higher if it's for software or other brands. And then again, one of Warren Buffett's favorite things to look for, free cash flow yield. Over 5% is what we're looking for. It doesn't have to be right there, but that's generally a very good spot and it shows you're getting a real return on your money. So step number 5, one of the biggest things that I focus on, catalysts. Catalysts are what make a stock actually move, whether it's a good earnings beat, new products, regulatory things, anything like that. I ask myself, what can make profits jump or make sentiment improve in the next 6 to 12 months? A great example here is maybe Tesla's Model 3 launch or new NVIDIA chips being launched, just things like that. The last thing I focus on is who's buying and when. If insiders are buying a ton of shares, that's clearly a good sign. It shows they believe the company's undervalued. Also, if big funds are adding positions, that's always extra validation that we could look for. However, if they're selling, you may want to be cautious, but that's not always a bad sign. Sometimes people just look to diversify and take profits. Overall, though, going back to different types of stocks, if it's a growth stock, you can obviously give it a little bit more room on valuation, such as revenue and margins if they're expanding. For value stocks, I'm focusing more on cash flow and a low PE ratio. For dividend stocks, I just make sure that payouts are covered by real profits. For turnarounds, I just really make sure that management is doing things to fix it. Anyways, I hope this video helped you guys get a better understanding of generally what a lot of these professionals use as a framework to analyze stock. If you guys are interested in looking at what I'm doing and seeing kind of what my community of around 100 members are doing, I do have a Discord link that I have down in my bio. Pretty much just share any ideas I have and track my own portfolio along with the other people in my group. Again, make sure you guys hit that subscribe button if you haven't already, and please leave a like if this video helped.